Welcome back to Metal Market News. I'm Professor Harry, and as always, I'm here to break down complex macro signals from an independent analyst's perspective. And what we're looking at right now is not just another discussion about gold and silver prices, but a much deeper structural transition in the global monetary system. One that goes far beyond short-term volatility and into the architecture of how trade, reserves, and settlement could function in the future. Because the core argument being presented by analysts like Luke Groman is not that the dollar is about to suddenly collapse or be replaced overnight, but that the world is gradually shifting toward a multi-currency system where gold reemerges as the ultimate settlement layer. And this is a critical distinction because most investors are still stuck in a binary mindset of a dollar via something else, while the reality may be far more complex and nuanced, where multiple currencies coexist for transactions but imbalances are settled in gold, effectively bringing the system back to a structure that resembles pre-20th century monetary frameworks. And this idea gains even more weight when you consider geopolitical signals, including remarks attributed to Vladimir Putin and Xi Jinping about changes not seen in 100 years, which aligns with historical parallels like the Genoa Conference 1922, where the global reserve system shifted away from pure gold, backing toward a hybrid model involving currencies like the dollar and pound. Something that Jacques Rueff later criticized as a fundamental flaw or original monetary sin. And from my independent perspective, while this historical framing is intellectually compelling, it's important to recognize that today's system is far more complex and interconnected, and meaning that any transition back toward gold-based settlement would likely be gradual, uneven, and filled with friction rather than a clean or immediate reset. But the direction of travel does appear to be shifting, especially as confidence in fiat frameworks continues to erode under the weight of deficits in monetary expansion, which brings us to the first major implication of this thesis, that gold is no longer just a passive store of value, but is increasingly being repositioned as an active strategic asset within the global financial system, particularly as infrastructure developments in Asia, such as expanded gold clearing systems in Hong Kong, begin to support this transition. And while I agree with the broader direction of this argument, I would caution that the scale of change required to fully implement such a system is enormous, meaning that markets may take years, if not decades, to fully price in this shift, and during that time, volatility and conflicting signals will remain a constant feature. As we move deeper into the mechanics of this potential transition, one of the most important and often overlooked aspects is the sheer size mismatch between commodity markets and the gold market. Because if you're talking about using gold as a settlement layer for global trade, you're effectively trying to absorb a system where commodities are estimated to be 12 to 15 times larger than the gold market itself. And this is where the argument becomes particularly interesting from a valuation standpoint. Because if gold is to play a central role in settling trade imbalances across such a massive system, then by definition its price would have to revalue significantly higher to accommodate that demand. And this is exactly where analysts like Groman suggest that the current pricing of gold may not reflect its future role. But from my perspective, this is also where the argument becomes more speculative, because while the math supports the idea of higher prices, the actual implementation depends on political will, institutional coordination, and market acceptance, all of which are uncertain variables. And at the same time, we are seeing early signs of this shift in practice. With innovations in places like Singapore, where gold is being used as collateral for settlement in energy and commodity trades, which suggests that the transition may not be theoretical, but already in motion, at the margins, however. It's important to balance this with the reality that the dollar still dominates global liquidity in financial markets, meaning that any transition toward a gold settlement system would likely coexist with the existing framework, rather than replace it outright. And this coexistence could create a period of instability where markets struggle to reconcile two parallel systems, one based on fiat liquidity and the other on hard asset settlement. And this duality could lead to significant price distortions and volatility. especially in gold and silver. As investors attempt to anticipate how much of this future demand is already priced in versus how much remains to be realized at the same time, when we analyze market behavior in traditional safe havens, particularly U.S. Treasuries, we begin to see signals that reinforce the idea of a deeper structural shift, because historically, in risk-off environments, capital flows into long-term government bonds, pushing yields lower. But recent episodes have defied this pattern, with yields rising instead of falling even during periods of geopolitical tension. And this is a critical signal because it suggests that confidence in sovereign debt as a risk-free asset may be weakening. And when you combine that with the fact that gold has also experienced unexpected selling pressure during these same periods, it creates a confusing picture on the surface, but from an analytical standpoint, it may actually indicate a broader repricing of risk across all asset classes, where traditional correlations are breaking down. And this is where I partially agree with the argument being presented, that markets are no longer reacting in predictable ways, because the underlying assumptions of the system are being challenged. However, I would also emphasize that short-term market behavior can be influenced by liquidity conditions, positioning, and technical factors, meaning that not every anomaly should be interpreted as a structural shift. But when these anomalies persist and begin to align across multiple markets, they do warrant closer attention, and in this case, the combination of rising yields, unstable gold pricing, and geopolitical uncertainty that suggests that the system is under stress, even if the exact outcome remains unclear. As we continue to build this picture, the role of global production, and what Groman refers to as a factory power, becomes increasingly important, because the emerging system appears to be driven less by financial dominance and more by control over real economic output, particularly in countries like China, which has established itself as the central hub of global manufacturing over the past decade. And this shift from financial power to production power has significant implications for how trade and settlement systems evolve. Because countries that produce essential goods and commodities have greater leverage in determining the terms of trade. And this is where the idea of settling in gold becomes strategically attractive, as it provides a neutral benchmark that is not tied to any single nation's currency. And from my perspective, this is one of the strongest aspects of the argument, because it aligns with observable trends in global trade, where countries are increasingly seeking to reduce reliance on the dollar without necessarily abandoning it entirely. However, I would also point out that transitioning to a system based on production power introduces its own set of challenges, including supply chain vulnerabilities, geopolitical tensions, and the potential for fragmentation, all of which could complicate the implementation of a unified settlement framework. And at the same time, the emphasis on commodities such as energy and food as foundational assets suggests a reordering of economic priorities, where tangible resources take precedence over financial instruments. And this could have profound implications for investment strategies, particularly in terms of asset allocation and risk management. Ultimately, when we step back and look at the broader trajectory, what emerges is a scenario where the global financial system is gradually evolving toward a more multipolar structure, with gold playing a central role in bridging the gap between competing currencies and economic blocs. And while the dollar is unlikely to disappear, its dominance may erode over time as alternative systems gain traction. And this transition, if it continues along its current path, could lead to a revaluation of gold and silver that reflects their expanded role in global trade and settlement. But from my independent analysis, the key takeaway is not to view this as a sudden or binary shift, but rather as a long-term process that will unfold in stages, with periods of acceleration and consolidation along the way. And this means that investors need to be prepared for volatility and uncertainty, rather than expecting a smooth or predictable transition, because history shows that monetary transformations rarely happen gradually or cleanly, and often involve significant disruptions before a new equilibrium is established. And in that context, the most important question is not whether gold will rise, but how the system will adapt to accommodate its increasing role. and whether markets will be able to absorb that transition without triggering broader instability. Because if gold does become the ultimate settlement layer in a multi-currency world, then its price will need to reflect the scale of global trade it supports, and that adjustment being, whenever it fully materializes, is unlikely to be subtle or incremental, but rather a defining moment for the entire financial system.